Next is learning objective 4-3. Make calculations and prepare consolidations for the consolidation of a wholly owned subsidiary where there's a complex positive differential at the acquisition date. And what we mean by complex here is that there are several different items that comprise the differential. So Peerless and Special 2 template. And Peerless acquired all special stock for $400,000, issued bonds to pay for it, $100,000 at a 9% rate, and paid cash of $300,000. Special's book value at the time was $300,000. Here you can see Special's balance sheet, and as you can see here, stockholders' equity of Special on their books is $300,000. And here are the fair market values of Special's liabilities and assets, and we can find the difference. So you can see here that inventory needs to be written up by $15,000, land needs to be written up by $60,000, and buildings and equipment needs to be written down by $10,000, and that's net. You're going to see later on there's $300,000 in accumulated depreciation on there. Anyway, accounts payable is the same. Bonds payable needs to be written up by $35,000, which means really that you need to subtract $35,000 from the difference, because the liability would be $35,000 higher. Therefore, the difference between the book values would be $35,000 lower. So these are all of the differences here. This is what would account for the differential, except perhaps if there is some goodwill. And they add up to $30,000. So the journal entry for Peerless to record the acquisition would be to debit investment in Special Foods for the amount of money paid, which is $400,000. Credit bonds payable for $100,000, and credit cash for $300,000. So how much goodwill is there? And you could do the whole calculation if you like. If you're working for a big international accounting firm, you probably want to do the calculation in a very formal way. I'm going to use my method. They're paying a total of $400,000 here. The fair market value of the net identifiable assets is $565 minus $235, right? Because that's the fair market value of Special's balance sheet. So that's $330, and the book value is $300,000. So write-ups and write-downs are equal to $30,000, which is what we got there. And therefore, goodwill must be $70,000. So write-ups and write-downs of $100,000, of $30,000 plus goodwill of $70,000 would account for the full difference between the cost of $400,000 and the book value of $300,000. So now let's consolidate the balance sheets on the date of acquisition. And in a couple minutes, we're going to get into balance sheets after acquisition, so you can see how that's going to work. First thing that I'll do here is I'll eliminate the stockholders' equity, the sub. That's 200 debit common stock, 100 debit retained earnings, and the corresponding credit would go to the investment account. Next, I'm going to do a write-up entry. And what this entry will do is write up the individual assets to their fair market value. So for example, inventory should be written up by $15,000. So I'm going to debit inventory for $15,000 because Special's inventory, it's on their books for $60,000, but we determine the fair market value is $75,000. Similarly, the land should be written up by $60,000, so I'm going to debit land for $60,000. Buildings and equipment should be written down by $10,000. So I'm going to credit buildings and equipment for $10,000. And bonds payable should be written up by $35,000. So I'm going to credit bonds payable for $35,000 right there. And the difference between all of these is going to be credited. Oh, one more thing. There's goodwill. So there's a new line item here for goodwill right here. And we said that goodwill should be $70,000. And the final piece of this journal entry, all of these items, is going to be the investment account. So it'd be 15 plus 60 minus 10 plus 70 minus 35 would be a credit of $100,000. Let me highlight this entry for you. And that eliminates the investment in special foods. And you can see your assets still equals liabilities. Debits in these journal entries is 445 so far. And credits are 445. Okay, good. Everything balances. Last thing is the accumulated depreciation. They have $300,000 in accumulated depreciation on the date of acquisition. So we're going to need to eliminate that. I'm going to debit accumulated depreciation for $300,000 and credit the building also for $300,000. In a couple minutes, you'll see how we would do this going into the first year and then even going into the second year, because then you're going to have your income statement and your statement of retained earnings to worry about also.